Life is like a camera. Focus on what is important, capture the good times, develop from the negatives, and if things don't work out, take another shot. Hello, everyone, and welcome to another episode of Podnuts Pro. I'm your host, Marvin Bee, and we are coming at you live on a Friday where things are going to be fun. And how fun, might you ask? This fun.
Cash, cold, that's what I need.
We are going to be talking about money. Specifically, how can you protect your money in this upcoming tax season? I'm joined by my good friend and fellow Floridian, Rayanne Buchianico. Rayanne, how are you?
I'm doing great today, Marvin. Good to see you.
Good to see you. You have your...
Thanks so much for having me on.
Oh, good to have you. Is that your flamingo pink on?
Yes, this is my special Florida, what is it? Coral, pink flamingo, the whole bit. Yep.
There you go. All right.
I'm generally not a pink person, though.
Generally?
Generally, I'm not a pink person.
Okay. I don't even know what to say about generally.
It's a term that the IRS embraces, right? So whenever the IRS comes out with a rule, they always start the sentence with the word generally, or, for the most part. So because nothing is ever absolute with the IRS, so there's always there's always some exception.
Oh, I see. So that's why they're kind of like HIPAA. So the rules are ambiguous for a reason.
Right.
Okay. All right. So normally we start off with the weather check, but we are both in the same state. So I believe we are experiencing pretty much the same weather today. It's not as sunny as it usually is. How is it for you over there on that side?
Also not as sunny as normal. It's a little bit of an overcast. I see some blue, but anyway, it's still a beautiful spring day.
Yep. Still 81 with a real feel of 82. Better than most, right?
Right.
Okay. So ladies and gentlemen, today we have a special day. For most of you, you hopefully realized that tax season did not end on April 15th like it normally does. It was extended. And so people are now postponing their panic before they file. And Rayanne, I got to believe that you have to deal with a lot of companies that are like, what can we do to protect our money and get a bigger refund and all of that stuff?
So I get a ton of that, right? As a matter of fact, and of course we're recording this a week after the April 15th deadline. So, the fact that we're still talking about taxes is a pretty good indication that they were not really due on April 15th like normal years. And last year it was extended to July, but this year the IRS did not want to go all the way out to July, but they were willing to concede May. So May 17th is the new due date for some tax returns, not all of them, and we'll get into that. But there's a lot of people out there that never even realized that they moved the date. I can't tell you how many clients call me last week and say, hey, today's filing deadline, where's my tax return? And, and so you probably see the big pile of taxes, behind me. So that's where their tax return was, and at the time, and I had to explain to them that no, you're fine. We still have another month, or if we're missing information. This one woman, went into a panic because I asked her, I told her that there was some information missing, and she thought, well, it's the 10th. How am I supposed to get this to you in the next 4 days? And I said, no, don't worry about it. We've got plenty of time. So we do get an awful lot of that.
So interestingly enough, so we never file our taxes at the early part of the year. I'm set up as a C Corp. So we always pass through the business to the personal. So we always extend out from the April 15th, or this year, May, and file everything. I think it's October. And it always ends up being funny because the rush for us just happens twice, because we still have to file a form to say that we're going to extend. How many people do you have like that are set up in that way?
So C Corps, they've recently changed the due date from March 15th to April 15th. They did that about 2 or 3 years ago. And C Corps were actually not given the extension to May 17th this year.
Oh.
Only the 1040s got the extension to May 17th. So C Corps and trust returns that were due on April 15th were still due on April 15th this year. So I'm certain that your tax preparer would have filed an extension for you if they were used to doing that.
I hope so. I'll have to check with my office manager. She didn't let me know. Usually, I think I usually have to sign something. I don't remember signing anything.
No, generally the tax preparer can just file the automatic extension. And of course you want to file the extension if you're not planning to file on time. Even though there's nothing due and there's no tax due with the extension, and it's automatic, if you don't file the form, then technically your tax return is late and you end up getting a bunch of ugly penalties that you don't really need to get from the IRS. So
and I will say this from personal experience: you don't want to be late, and you don't want the penalties.
No, you don't. Especially like the S corps. S corporations, which I know that you're a C, but S corporation penalties are crazy. It's like $450 per shareholder per month. That the return is late. I mean, so those penalties can get pretty high pretty quickly.
Yeah. And I have to apologize. I need to check something. I believe we are an S Corp. Yeah, just open my QuickBooks. We're an S Corp, not a C Corp.
Oh, okay.
I don't know why I made that mistake.
So those S Corps, they were due in March. And so hopefully, I'm sure that you would have filed an extension by now.
Yeah, I hope so. All right. So normally we start the show by doing an In the News segment, but this is a special Friday edition, so we will skip that. We still will do a Florida Man or random question section at the end, so Rayanne, be thinking about that to see if you want to challenge a Florida Man story or if you're just willing to answer a random question, whatever it may be.
I'll think about that. Thanks.
Okay. All right. So I wanted to talk about this because, of course, tax time is something that most companies, whether you're a solo tech, a small MSP, large MSP, we always want to figure out ways that we can protect and save our money. And taxes are one of the things that I think a lot of us don't really focus on. We focus on how do we lower our RMM cost, or how do we, lower our monthly fees for storage and backup and all of that. But one of the areas that we always fumble at is taxes. And I know that it took me a long time to work with my accountant to get a lot of the categories correct, because we like to do things a little bit different. Not everything is an expense, and RMM fees, what category do they go under? Are they a client cost? Are they an expense? If we purchase equipment that we then resell, on a monthly basis? Is it an asset or CapEx, OpEx, all that stuff? So it was very interesting. So I mentioned a couple of weeks ago an article from the Hartford that talked about 5 tax moves that will save your business money. And we'll talk about a couple of those, but let's start at the beginning, Rayanne, with the things that you think MSPs should know right off the bat, with things to note for this year versus other years when they look at their taxes.
Okay, so there have been so many changes this year, and the first thing that I want to talk about is about the PPP money that so many of us received last year in 2020. So you received the Paycheck Protection Program loans from your bank or the SBA, and then you were required to spend that money on payroll and other operating expenses. And so you've done all of that, and so all along they were telling us that while that money wouldn't be taxable, those expenses would not be deductible, but they are. So on December 27th of 2020, it was turned into law that the expenses that were paid with PPP funds are indeed deductible in the year that you expensed them, in the year that you paid them. So you received the money, the PPP money, in, let's say, May of 2020, and the money was all gone by, let's say, September. So then for those 4 months that you were spending that money, you can still deduct the payroll expenses, even though the money was technically given to you in order to make those expenses. So there's no reason to separate the expenses out any longer. There's no reason, to try and figure out which one was, done. But I will tell you one thing, though. There's no double dipping. So there's a bunch of different credits, payroll credits. There was, like, if one of your employees got COVID, right? So let's say, for instance, one of your employees or you got COVID and you couldn't work for a couple of weeks. Well, the IRS was giving out payroll tax credits for the time that you were out of work, up to 10 days, up to 10 business days, and there were certain dollar limits on that as well. And so you can't take that expense and then take it again. So you can't double dip on that. So it's one or the other.
So was that money given to the employer to give to the employee, or was that direct to the employee?
It was money that the employer gave to the employee and then received a credit on their payroll taxes equal to the amount, which was $200 per day per person, up to $2,000. And I think there was another one, and there was $5,000 per day up to 10 days if you were sick. The 200 is if somebody in your family was sick and you couldn't work. So that was from the very first stimulus plan that came out back in March of 2020, early March. It was called the Families First Coronavirus Response Act, FFCRA. And so there was all sorts of different, and as a matter of fact, in December of 2020, they extended that. And I actually had the opportunity to use it for the first time, a couple of weeks ago, when my office manager was tested positive for COVID. And so she had to stay home for 2 weeks. She was quite sick. And she was very concerned because she was brand new, and she didn't, she has a young child and didn't really want to lose the pay. And I'm like, first of all, no, don't come in. We don't want you here. Stay home, and don't worry about your pay because the IRS is going to cover that. So, and so I was able to take advantage of that credit. And they've extended that credit through the end of June of 2021. And I suspect that if we don't get this pandemic under control, they'll extend it again. So if any of your employees or any of your family members come down with it, the IRS has got your back for payroll.
Okay. So that was the Family First Coronavirus Response Act, the FFCRA. How different is that from the Employee Retention Tax Credit?
So the employee retention tax credit is, you know, gosh, and I should have looked up these rules because, and I did look them up last week because somebody else had asked me about the same thing. So if you are maintaining the employees, and you also have to have a reduction of, income in order to, and be able to maintain those employees in order to qualify for that. I recall that the FFCRA does not require the reduction in income in order to get those tax credits.
So you're talking about sales income.
Correct.
Okay.
Yeah.
Interesting. All right. So obviously maximize your stimulus benefits is something to do. And you're saying that they relaxed the paperwork required to prove that, right? Because it used to be you had to document the money coming in and the money going out, but now you don't have to document it. It's part of a regular expense deduction.
As long as those PPP loans are under 150,000, you don't have to send in any documentation. You simply have to, check the box that, you understand that you had to spend the money in a certain way and that you did indeed spend the money as it was required.
Okay. All right. And I know I probably didn't prepare you a lot for this question, but what is the Work Opportunity Tax Credit?
So the Work Opportunity Tax Credit is a credit that, so if you're hiring somebody and you specifically hire, let's say you hire a disabled vet that, from the military, or even a released from jail, I believe also qualifies for the Work Opportunity Credit. So if you hire, somebody in these targeted groups of potential employees and you hire from them, then there's a credit against payroll taxes, for a percentage of their salary. So, so absolutely, if you're, and it kind of reminds me of the Empowerment Zone credits as well. But, they are payroll tax credits that are encouraging you to hire disabled vets, and people released from prison. So, and I know, I know that it sounds weird, hey, that, we've got to look out for the people coming out of jail, and it's always such a stigma. So to hire like an ex-felon, as soon as you hear the word felon, everybody was like, whoa, I don't want this person in my, in my business. I get that, but there are credits available should you have an opportunity to provide a job to either an ex-felon or, more importantly, the disabled vets who definitely need jobs when they come home.
All right. And yeah, the word felon, some felons are created more equal than others, right?
Right.
So here's a question so my company, we were lucky enough that we didn't need the money. I don't know if that's the way to phrase it. I didn't go out grabbing the money as soon as it became available because I wanted to see if we could make it. Most of my clients continued to work, and officially I have 3 employees, and all of the technicians that I use are all subcontractors and stuff like that. So of course everybody is like, well, I'm getting the money regardless. Did I miss out by not going after any of that money, or, what kind of things did I miss out or not, I guess is the best question.
And that's such a hard question to answer because I know a number of MSPs that never did go after that money. They felt like I have enough cash in the bank, and I don't, I would really prefer to leave it for others who need it so much more than I do. And, I find that very admirable that you can say, you know what, I'm doing okay over here. And, and again, there's nothing wrong with saying, I'd like to get that money, and sock it away for, for that time, just in case the bottom falls out, of this economy. And here we are a year later, and the economy is probably booming just as much as it ever has. People are starting to actually leave their homes again and go to restaurants. And there's actually tax deductions to, encourage you to go to restaurants now too, oddly enough. So did you miss out on anything? Probably not, because if you're not missing the money now, then, then you probably did not really miss anything in the meantime, before, other than you'll probably never have somebody offer you free money again. It was literally a once, a once in a lifetime thing that the government says, here, you have some money on us. That just doesn't, doesn't happen.
No, and I guess that's the reason where, if it's there, take it. But my question was, if you took the money and then didn't use it or didn't need it, is it something where you're still going to have to do something with it? Do people have to give it back, or do you just kind of roll along and, because you can't count it as income, right?
No, you're not counting it as income, but, assuming that you are paying the payroll, that you would have paid. You have 3 people on your payroll. You continued to pay them, and you would have continued to pay them whether or not you received the PPP money. And that's pretty much the same as every other business out there. They still continued to pay the payroll. It's just that they didn't have to use their own cash to make that payroll for 8 weeks, or 10 weeks or whatever. And so they were able to take the money that they would have used for payroll and put that aside for a rainy day. And that's an opportunity that many companies just never would have had any other way. Like, for instance, let me just give you a couple of examples. So there was one company, and they, every 2 weeks when they would run payroll, they struggled with cash, and they had credit card debt through the roof. They could, they paid it down enough so that they could continue to buy and run it back up. And so when they finally got that 8-week, reprieve on their payroll, they were actually able, to make some smart decisions. Well, we don't have to use this money on payroll this week. Let's pay down this American Express bill, and get this monkey off our back, and let's pay down this credit card bill, So they still had all of these bills, but what it really did was it saved them from the concept of possibly either going under in order to keep everybody paid and, running smoothly, or they could have used that money wisely like they did, and okay, if the PPP money is covering payroll, then let's take that money we would have used and pay down some of this debt, and they put themselves into a much better position to move forward as a company.
All right. I was just thinking that I know that there were some companies that misused that money in the beginning. We don't really want to get into that too much, but that's why I asked the question about giving it back if we didn't use it. But
no, I can't tell you that, and I work with strictly primarily MSPs and IT firms. That's like 90% of my accounting firm business, and I don't know one company that misused their funds, and I know that there was that guy in South Florida that bought himself a speedboat or something, and I'm sure he's enjoying that from his jail cell right now, but for the most part, people just want to do the right thing. And I don't know anybody, and if I did, I would have called them out on it. You can't do that.
Right.
Like the EIDL loans, were very specific for for working capital. You can't go and buy a building with your EIDL loan. It's written right there in the document. And if you try to do that, you're breaching your own the contract that you signed. And I would call anybody out on that.
All right. And yes, the person that abused, I believe it was $7 million in total here in South Florida. Joy, joy, joy.
Does that count for a Florida man story?
That counted as a Florida man story. Yes, it did. Yes, it did. And we had a ton of them. I can't even count the stories between that and tattoos and gators and all that stuff. Although a lot of them are happening up by you right now. So.
Oh, really? I
Yeah.
guess I must not be watching too much of the news.
That's okay.
I'm still buried under taxes over here.
That is true. That is true. So in terms of now getting away from the government stuff, in terms of those programs, a lot of changes you mentioned happened on the deductions and actual filing stuff. What are some of those?
So the IRS just handed out some guidance on, the meals deduction. All right. So back in 2017, there was a tax reform act that was put out. It was called the Tax Cuts and Jobs Act of 2017. And as many of you probably know, that entertainment expenses have been removed from the map. So buying baseball tickets and taking your clients to baseball games or basketball games, no longer deductible at all, period. Entertainment is gone. And the meals deduction was, stays at 50%, but is also expected to drop off by 2025 entirely. However, since the pandemic started, and all of the restaurants started closing because, people were not allowed to go out and social distancing, and restaurants had to cut their seating capacity, into a quarter of what it was. So the restaurant business really, really got hurt during the pandemic. And I want to say it was President Trump that put this out there, that so the meals deduction, any business meal that would have been deductible at 50% and paid and purchased in 2020 or 2021, so this rule is good through the end of 2021, any business meal that would have been deductible at 50% is now deductible at 100% for the years of 2020 and 2021. Where is it just 2021? But I'm pretty certain it's both years.
Interesting. So that was, they really plan on getting rid of that altogether? No meals expense?
No meals expense after 2025.
What about like travel and accommodations and that stuff?
So travel expenses will not be affected. It's just the meals and entertainment.
Okay.
And I don't know why they decided to target that. But I will tell you that meals and entertainment is, is one of those triggers for tax audits. Well,
of course, when you're, going to a baseball game, playing golf, visiting strip clubs, is that really?
Can I just put this out there? Strip clubs and alcohol are never deductible. Maybe I'll save that for my Florida story.
Oh, so you do have a story.
You just reminded me of one, so perhaps.
Okay, interesting. All right. What other deduction changes were there?
So this is a really interesting year. And if you have not yet filed your 2020 income tax returns, consider this. So for the first time ever, it really is worth taking a look at your filing status. So if you're married, and generally you file married filing jointly because it's historically always been the best filing status to have, right? Because you get a lot more benefits and you get a lot more deductions, if you're filing married, filing jointly. The minute you would file separately, certain deductions go away. If one person itemizes, the other person has to itemize. So you can't take a standard deduction and file separately while your spouse is taking the itemized deduction, right? Other things that go away are student loan interest deductions and, certain child credits. And, there's a bunch of deductions that just kind of, go away when you file married separately. However, in 2020, things that don't go away just because you're married filing separate is going to be the stimulus checks. So if one of you is making, $150,000, why drag your poor spouse along with it? Because if your spouse is making $30,000 and you're making $150,000 together, you're way over the $150,000 range, and neither of you gets the stimulus. But if you file separately, you don't get the stimulus, but your spouse does. And so that's when one tax planning avenue that you can and you're probably fact checking me right now, aren't you?
Well, I'm trying to think, because we've already gotten the stimulus checks. So
okay,
if we're talking about filing now, are we talking about a possible third or fourth stimulus check coming out that we would?
Well, so there's lots of people who didn't receive the stimulus checks in 2020 because it was based on their 2019 income tax return. So if in 2019 you filed a tax return and collectively you did not qualify for that, you could file your 2020 returns and now collect on those stimulus checks.
Oh, so you can retroactively go back and get the check if you did not get it before.
Right, because actually those stimulus checks were in advance of 2020 taxes.
Oh.
So it was based on your 2020 taxes, but it was paid in advance using your 2019 as a guide. So if in 2019 you had super high income and then in 2020 super low income, you would end up getting those stimulus checks or those rebate checks in your tax refund, or it would reduce your 2020 tax directly. So you can still use this as a tax planning tool.
All right. So people need to know that their refund is going to be reduced by the amount of the stimulus check you already got.
No, it will not.
Oh.
No, you don't have to pay it back. And so like even if you had low income in 2019 and high income in 2020, you got to keep the stimulus check you already received and you were not required to pay it back. So no, your refund will not be reduced, but your refund could be increased by the checks that you did not receive.
Okay.
And then of course, the third check that just came out, the $1,400 checks, they are an advance of your 2021. So if you don't qualify for that check in 2021, if you didn't qualify to receive it and then your income goes down, then you'll get it next year on your 21 income tax refund.
Okay. And that's the one where they changed the limits to the 150 combined, right?
Right.
Okay.
Yeah.
All right. I'm going to stop paying the wife so we can stay under the 150.
And I know that there was something else. So it wasn't just, you know what else? Is the unemployment taxes, the unemployment benefits. So if one spouse collected unemployment and the other spouse did not, and you put all of the money together and it would kick you up over that $150,000 magic mark, then all of the unemployment would be taxable. But if you file separately, then the unemployment on the spouse who was collecting unemployment and didn't make over $75,000 would still have the first $10,000, waived and, is not taxable. So that's important too.
All right. It's a lot of things to remember.
I'm sorry. I know. There's
Well,
so
that's
many.
why we have people like you. And for people that have been following along, whether watching on the video podcast or if you are listening through the audio podcast and you're like, okay, who is this Rayanne person and why should we trust her? Well, Rayanne has been running her business, ABC Solutions, for a lot of years now and has, as she mentioned earlier, specialized in the IT field, helping MSPs and IT firms. And of course, I'll have the link to her and her company in the show notes. But this is the reason I wanted to have you on here, because you know all this stuff, and it's a lot of stuff.
Well, I'm an enrolled agent, which means, I'm enrolled to practice before the IRS, and I do so in all 50 states of the union, and we're tax experts, right? So, CPAs get licensed by the State Board of Accountancy, and they have to know tax, they have to know auditing, they have to know, all different areas of accounting. Enrolled agents are 100%, tested in tax. And so every year I have to, do my 40 hours of continuing education in tax. So
40 hours.
So,
Wow.
yeah, it's a lot. And so if you ever want to find me, in November or December, chances are I'm at my desk reading tax law. So you'll always be able to know where I'm at.
All right. So let's go off script here. And let me ask this question. How difficult is it to know tax codes for all 50 states? I mean, Florida alone is, a mess when it comes to state taxes, even though we don't have a state income tax.
Right.
I mean, that's a lot just to do the state of Florida, but to do all 50?
So do I profess that I'm an expert in all 50 states? No, but I am very good at reading instructions and, publications. So, if a specific, if a specific tax situation comes up, I know how to handle it for the federal government. And, the thing that to understand about the states is that, the states run parallel to the IRS code. And they do it in one of two ways. One is a rolling conformity, so that every time the IRS changes its rule, the state changes their rule. And the other is a static conformity. So they say, as of a moment in time, we are adopting the IRS code, and so whatever the law was on this specific date and time, that's what our law is, until the next time, that state Congress gets together and passes, an update to the tax law. So as long as I know, with the states that are rolling conformity versus static conformity, and I know what date the static conformity was adopted, then I know how the states will treat the tax event.
Okay. So
more accounting mumbo jumbo, right? Wah, 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 wah.
it's all right. It's all right. You saw my eyes glaze over there.
I did. I knew it was time to cut it.
So here's a question. So, excuse me. So when we were talking about, what things we would mention today, one of the things that you brought up was state sales tax. And I know I saw in one of the groups probably about a week ago, and I don't remember if it was the ASCII group or one of the Facebook groups, where people were asking again the questions about when do I charge sales tax, and do RMM products fall under sales tax? And I know that Florida is one of those weird states where you can get away with not charging sales tax as long as you don't have a tangible product tied to it, or something called a use tax, which I've never understood what the use part of that is. So That's got to be something that varies state by state. But what is kind of like, if you can give us a general guideline as to how MSPs and IT firms can handle sales tax?
Okay, so and I really want to put this out there. Thanks for bringing this up because, you know, and I hate to keep mentioning this pandemic, but it has literally controlled all of our lives over the last 14 months, and and it has created some financial challenges for all of the states out there. And so the reason I really wanted to talk about this is because the states are kicking up sales tax audits. And I saw this once before, back in 2008 and 2009, when the states were all going broke and they needed money. So what's the best way for the states to collect a lot of money fast? Well, let's make sure everybody's paying all of their proper taxes. And so the easiest way to do that is to go after sales taxes. I can tell you right now, I have 3 sales tax audits going on right now. They all came within weeks of each other, and they're in different states. So, and I think that in the one common denominator that I noticed in all 3 of these is that none of these accounts were reporting use tax on their sales tax returns. And I think that that might be the trigger. So what's use tax? So use tax is sales tax. Let's say you let's say you have a relationship with, I don't know, I'm going to pick a vendor, Synex, and you buy all of your equipment from Synex. And so because you have a relationship with Synex, you've given them your sales tax resale license. So they don't charge you sales tax on anything you buy, right?
Right.
So, which is great because you buy the products from Synex, they ship it to you, you sell it to your customer, and then when you sell it to your customer, you charge your customer sales tax. What happens when you buy a computer from Synex and you use it in your own business? Now, you are the end user, and the end user is who needs to pay sales tax. Well, you didn't pay it to Synex because Synex isn't charging you sales tax. They've got a resale license, a resale certificate on file. They don't have to charge you sales tax. But it's up to you to make sure that you report the purchase of that computer on your sales tax return as a taxable purchase, right? So if you're buying yourself, new computers, new monitors, printers, whatever, if you are using it in your business and you did not pay sales tax on it when you purchased it, you owe use tax, and they're coming after you. So keep track of all of your receipts. Make sure that you have them because they will ask to see them. And if you cannot produce proof that you paid sales tax at the point of purchase, they're going to charge you for it.
Okay, so now that you mentioned Synex, a distributor, and this is going to get tricky because, so I use the 4 big distributors, and then I have another, online distributor that I use, and then there's Amazon.
Right.
A lot of us are using Amazon to purchase things for our customers. And in some cases, Amazon is charging us tax, and in some cases, they aren't. So what you're saying now is we have to keep the receipts separate, identify which items we're keeping for ourselves, and pay tax on those. Now, I have to assume, and I know the internet tax has been a freaking boggle for years as to when to charge tax and when not to charge tax. So how much more does Amazon compound this situation?
So yeah, Amazon is always challenging because it's really difficult to get receipts out of Amazon, right? You get an email that says we've received your order for this laptop, this monitor, and 6 other items, without any detail on it as to what those items were, how much you paid for it, or whether or not there was tax. You have to go into the order in Amazon in order to grab that information. And remember, it's okay to not pay sales tax when you're reselling the product. It's only required to pay the sales tax when you're going to be using that product in-house. And let me tell you, because don't even get me started on Amazon, because you might order a box of paper clips, and sometimes it will have sales tax on it and sometimes it won't. It really depends on who's shipping that box of paper clips to you. But if it's a box of paper clips and you don't pay sales tax on it, guess what? Use tax, right? Because you're not reselling the paper clips, you're using them. And so it goes with all office supplies and anything else that you might purchase, tangible items that you're going to purchase and use in your business. And if your state has sales tax, then your state has use tax. So, I put together this 9-page instruction on how to track use tax purchases, and you may be able to find it on my website on the resources page. And if it's not there, I will make sure that it's there by the end of today, because I have pictures of various states' sales tax returns where you can see specifically the lines, where you are to enter your taxable purchases. So I think there's one state out there that requires a separate return for use taxes, and that might be Ohio.
Ugh. Okay, we're going to have to look that up, because 9 pages, first of all, is a lot.
Well, but it's step by step with pictures, and first do this, and this is why you're doing this, and then do this, and this is why you're doing that, and this is what it's going to look like. So it's not 9 walls of text, I promise.
Okay, well, pictures make it better, so I'm glad you said that.
Pictures and arrows, and
I think I found it. Tracking and remitting use tax.
Use tax. Yep.
There it is. So, yep, there it is. And it is actually, you lied, Rayanne. It's a 10-page document.
Oh, sorry.
So
you'll see, you'll see on page 6 that it's just pictures of sales tax returns.
Yes, I see. And of course, on page 7, Florida has its own page.
Right.
So interesting. Yeah. And Florida, here's the thing. Florida, so when they changed the sales tax, what was it, 2 years ago or 3 years ago, when they added the penny. So it went from 6 to 7. But some counties, it was a full 1%. Other counties, it was a half a penny. And you
they
had
still
to,
have that. Mm-hmm.
And you had to track, for instance, we sell in 7 different counties. And I had to track the sales tax for each of those 7 different. So I had to make a freaking tax line for the additional tax for 7 different counties. And it was frustrating.
I have many simplified procedures for that, and actually, Florida is probably one of the easiest ones, right?
Really?
I am not kidding. I am not kidding, right? Because in Florida, you just need to know whether it's 6%, 6.5%, 7%, 7.5%, or now 8.5%, which is Hillsborough County. So. Because on the sales tax returns, you don't have to actually say, hey, this sale went to Pasco County, and this sale went to Broward County, and this sale, was in Brevard, and there are states out there, Marvin, I am not kidding, where you actually, take a look at California. California is insane. Not only do you have to list the county, but they have county, and they have city, and they have a community tax. So you might have to and then you have to actually say, all right, I'm in San Francisco, and and under San Francisco there's like a transportation tax, so that you've got to split out. It's crazy, so and so Florida is one of the simpler ones. It's not as simple as Michigan. Michigan is nice, 6% across the board. They don't have any counties that they have to split different taxes on, Pennsylvania's pretty easy. They've got Philadelphia and Pittsburgh are the only places that have additional taxes.
Okay.
But,
Yeah. Very interesting. So
sorry.
we're going to go way off. We're going to go way off course now
I
because,
go way off into the,
well, that's fine. So apparently this triggered because they had, so apparently we were filing the DR 15 EZ form. And then we switched to the DR 15, the long form. And they made it sound as though we didn't have to change. So is that another thing that could be triggering some of these sales tax audits? That they're realizing that too many people are just doing the EZ form and only calculating at the 7% for every county?
Right. Well, if you've got taxes in different counties at different rates, as long as everybody was in the 7%, county, and it doesn't really matter what county they were in. If they were all 7% and that was the only tax rate you were charging tax on, then yeah, you could probably still get away with the EZ form. But the minute that you sell something in a 6% or a 6.5% county, you no longer fit in that EZ form. So I think they're starting to move everybody to the longer forms to give you the breakdown.
All right. And I've got 3 offices in the Hillsborough County area, so maybe I'll have you start selling services for me. 8.5%. Wow.
8.5%.
That's not right. That is not right at all.
Yeah, so the next time you come up to visit them, you should come by.
Actually, well, I didn't try to visit you, but I did reach out to you the last time I was there, and I had an issue I needed some cables on a Saturday.
Both Saturdays, I'm probably here working anyway, but I probably didn't see it in time.
That's all right. We'll have to, I need to be better at scheduling my visits and allowing time to visit other people. So I just don't want to do that and have the wife back home while I'm, out having meal and entertainment expenses.
Meals, not entertainment.
Meals, I'm sorry, meals.
It's a business meal. It's not,
All right.
don't call it entertainment anymore.
Okay. All right. So I know we got way off track, so let's try to wrap this up. Was there
Sure.
anything else in terms of deduction changes or filing status changes or anything else that you wanted to mention?
So there's one other thing, the 1099K, right? If you're accepting credit cards in your business, then your merchant will send you a 1099K at the end of the year. And, companies like PayPal and Stripe, are now considered merchants. So if you are paying if you're paying a subcontractor and you use, a credit card or or even PayPal, you should not be issuing 1099s to them at the end of the year, because it's now assumed that the merchant will send the 1099K directly. And that's been the rule for about 3 years now. But the problem is that the 1099K forms were not issued from, PayPal or these merchants until you hit a $20,000 mark. And so there were a lot of people that were falling underneath the cracks and getting money without a 1099. Sole proprietors, because they were accepting PayPal as payment or Venmo as payment, or, or even credit cards or Stripe, and they never hit the $20,000 mark. And so the IRS got concerned, perhaps, that not everybody was reporting all of their income. So they reduced the $20,000 limit on the 1099K to $600 to coincide with the 1099 NEC. So anyway, any of you out there that are accepting, credit cards, from, by doing subcontract work or whatever, you can expect that on your 1099 now. So that's really all I wanted to put out there.
Okay. So that sounds like a whole nother topic too, because if you're talking receiving money through PayPal, but are you talking about it from vendors like, not PayPal. What is it? Because PayPal doesn't do eBay now, because eBay has their own eBay payment system. So if you sell on eBay, that's one thing. But if you're paying subcontractors through PayPal, you don't have to report the 1099 anymore. PayPal does.
Correct. And if you're selling stuff on eBay and then you can expect a 1099-K from eBay, if your sales exceed $600 in a year.
Ugh, I better check that. We do sell on eBay, but it was always for walking around money, for entertainment purposes only. Guess I'll have to pay
not
attention.
so much anymore. So they're on to you, Marvin.
Crap. Okay. All right. Well, that has been a little too enlightening. But
I know, and I know that it's income tax is not the sexiest topic in the world, but it is really important to stay on top of it and use it to manage your business. And there's no reason in the world that at the end you should get to your tax return in April and be surprised as to how much money you owe the government. You should know this well in advance, like months in advance, so that you can make plans to not have to pay that money. What can I do? Where can I put my money, so that I get to keep more of my money and pay less to Uncle Sam? So you should be doing income tax projections at least quarterly.
Okay. So with that said, I guess next quarter we're going to have a show on preparation. Is that what we're going to do?
We could, just have a little tax planning session or something like that. I could hand out my, my tax planning worksheet and I usually hand that out in my courses. So I could hand that out to your listeners.
All right. We'll talk about that and see what we can do. That sounds like something we need to do. All right. So Rayanne Buchianico, ABC Solutions, and I will have the link to her and her business there, and especially the resources page. There's a lot of stuff on there that you are letting people get for free. So there's a whole section on COVID documents. So nice.
I spent a lot of time working on, COVID and PPP and EIDL. I spent a lot of time writing and researching. So yeah, whenever I have information like that, especially for the IT community, I put it up on my resources page and I try to add to it as often as I can.
Sweet. All right. Well, Rayanne, thank you for that. And now comes your favorite time of the show, Florida Man or Random Question. So normally I would do a news segment where I would give my Florida story that I would pick, and I'll just give you the topic of what I would have done. And it is Netflix orders Florida Man starring Edgar Ramirez.
What am I supposed to do with that?
So you can either tell us your Florida story that would rival that, or you can choose to answer a random question.
I'm going to go with a random question because accountants are not known for creativity.
Okay. So with that, I'm going to go to my random question maker page and generate a question. I'm going to hit refresh right now. And the question of today is, what board game do you like the most?
What board game do I like the most? I'm going to have to say one of my favorite games was Sorry.
Really?
Because it came with the little bell, and then, and it became, so it was either Sorry or Parcheesi, and it might even be Parcheesi, because, do you ever, as you're driving down the highway, and you're trying to pass a car, but you can't because the car in front of you is playing Parcheesi with the car next to him, so you're stuck, right? So, and when my daughter and I used to drive back and forth from South Carolina together, and she would say, "Hey, Mom, want to play Parcheesi?" So we would purposely block people from passing us.
Okay, that's not right.
So, Anyway, Parcheesi absolutely had a major impact on my life.
I would say you're teaching your kid to be disrespectful.
So,
And let me guess, did you have a Florida license plate on that car giving way to another Florida man? Wow.
I'm not proud of that, but
Wow. Parcheesi rolling down the highway. I-75.
so, and anytime from this point forward, Marvin, I guarantee if you're in a hurry and you want to, and these two cars in front of you are driving super slow and you want to get around them, but you cannot, and you're going to be like, that's Parcheesi. So.
Okay, well, let me ask this. So did you have special moves like the game of Parcheesi? So if you were, just blocking somebody behind you, or if you were behind those two people, what would you do to get around it?
Now we're talking about, things that could, potentially involve road rage. So, let's not go there because this is a happy show.
Okay, we'll talk about that after the break. So no post show today, but we're going to definitely get into Parcheesi road rage. That should be interesting. Oh my. All right.
I'm much older and calmer now. This was when I was much younger, and
Okay, but you're teaching your daughter.
Yeah.
Oh my. So that is going to do it for this episode of Podnuts
Thanks so
Pro.
much, Marvin. It was a lot of fun.
I want to thank everybody for watching, and for those of you that are listening after the fact, learn how to protect and save your money. And Rayanne and I will be back with another episode, and we'll talk about how to set your business up right, to put it on autopilot, hopefully, and not have to worry about panicking around tax day. So we are normally here every Wednesday at 8 p.m. Eastern, but today was a special day. We have these from time to time. They used to be Facebook Fridays, but now they're just Friday whenever we have a special guest, which Rayanne is. So head on over to podnutspro.com if you want to look at the show notes and get that information we talked about, including her document on her resource page that talks about use tax. And we'll get some more of that stuff. And I was checking to see who I have for next week. I don't have them right in front of me, but I got a great show planned for next Wednesday. And that's going to do it for this time. On behalf of Rayanne and everyone else, thanks for watching. Thanks for listening. We'll see you next time. And until then, holla.